Okay, so good day everyone. So our topic for today, of course, is measuring and testing eco movements of returns. No? So again, it is important to understand that the precise measures of asset co-movements are important for a broad spectrum of application, which range from portfolio applications or allocations, risk management to monitoring financial stability. So an accurate measure of financial co-movements constitute an indispensable instrument in the toolbox of practitioners, researchers, and policymakers alike. So nevertheless, measuring codependencies across financial markets remains one of the open issues in international microeconomics and finance. Now, so the approach is based on the estimation on conditional probability that a random variable falls below a given threshold. No? When another random variable is also failing below the same threshold, the estimation is implemented through a simple OLS regression of appropriately specified indicator variables. So because thresholds are identified using time varying appropriate conditional and univariate quantiles, which allow to account for heterozygoticity. So the stronger the codependence between the two random variables, the higher the conditional probability of co-movements. So to give us more details about the topic, okay, let's just play the video presentations. First, these discussions about the for us to understand actually this one, we need to discuss first the financial market, as our initial discussion with regards to this. Okay, I just want to share the screen. And this video is coming from ACE 444 actually.
Hello and welcome to this first module of ACE 444. Hopefully you're listening to this, and this is an introduction to financial markets. Again, this is an online module, and you will be listening to a number of these each week during this semester. By just a little bit of housekeeping here, if you look to the left of the screen, you will see a list of slides. If you click on any one of those slides, you can move forward and backward and repeat any one of these slides. So maybe you might want to just play with that a little bit and see how you can move forward and backward. Again, another welcome to the class, and I hope you do enjoy the class. I enjoy teaching the class. I do like the material in this class. Financial markets are very interesting, and during this semester we'll introduce you to some of the more interesting, I guess, news of the semester, and there's undoubtedly will happen. Some news will occur during the semester that will impact portfolios. My objective in this class overall is help you pick a portfolio of assets that meets the goals of a particular individual, and that could be yourself or an institution. You could be working for someone else or another person and picking a portfolio or helping them pick a portfolio that meets their needs. Obviously, when you're picking a portfolio, you need to know something about the goals of the individual or the institution, so that comes into play. How much risk they're willing to take and how long they're willing to keep that investment made, or are they looking at the short term or long term. All of those things will have an impact on the portfolio that is picked. Again, what we'll be doing here is looking at that portfolio selection process, as well as looking at some of the information and news that impacts how those decisions are made. Again, the overall objective is to pick a portfolio that meets the needs of an individual or institution. We're going to begin at the basics, and that is, what is a financial asset? And these financial assets are what fit into the portfolio of the individual, and those financial assets can include many different things, and you see a number of examples here on the screen. The first four of those: bonds, a bond issued by U.S. Department of Treasury; GE, or corporate bond, or a bond issued by the state of California; a municipal bond, bond issued by a government of France, which in our case would be a foreign bond. All four of those bonds are items that we'll talk about as we're moving through the course. Another or a couple more are examples of financial instruments are automobile loans and home mortgage loans. Both of those are made and can be and have been held by individuals and institutions. And by the way, automobile and home mortgage loans typically aren't held, or the asset isn't held by the individual, but by an institution. Although they do sneak into portfolios, particularly if you have an investment in a managed portfolio. Those may be in there. Final two items are common stocks, and Microsoft Corporation and Honda Motor Company are two examples of those. As we're moving through this course, we're going to be talking about picking common stocks, or our first module will be talking about stocks. So that will particularly deal with Microsoft Corporation and Honda Motor Company. And then bonds will be our second module. So we'll specifically deal with U.S. Treasuries, corporate bonds, and municipal bonds. Those are listed there. And we'll talk a bit about automobile loans and home mortgage loans in that bond sections as we're moving forward as well. In this class, we are going to focus primarily on publicly traded assets. And these are assets that are traded on public exchanges, and anyone can conceptually purchase these assets. So we're going to focus on publicly traded assets. That doesn't mean that an asset that is not publicly traded isn't a good investment, but we again are going to focus on publicly traded because they are available to all individuals. What that does mean is that there is, or usually is, a secondary exchange in which those assets are traded. And for stocks, the examples include the New York Stock Exchange and NASDAQ, National Association of Security Dealers Automated Quotations. We're looking at those secondary exchanges. In fact, most of the time when an individual purchases an asset, they're purchasing that asset from a secondary exchange. That means that they're, for example, let's take the case of Microsoft Corporation stock. They aren't buying a new asset or a new piece of stock. They're buying a stock from a secondary exchange and purchasing that asset from somebody else. They don't necessarily know who that individual is, but they buy it through a secondary exchange. No need to know the buyer or seller in that case. That also means that we'll be generally following prices after the initial public offering. I'm going to take a little time here on these next two slides to specifically just mention a couple examples of the secondary exchange and an IPO, just to give you a couple of examples of that, and that have been in the news here of late. Occasionally, the exchanges themselves make the news, and last Friday, in fact, NASDAQ was in the news, and not in a manner that the owners of NASDAQ, which is a publicly traded company, would enjoy it have occurring. NASDAQ is a electronic market in which stocks are traded. Microsoft, for example, is traded on NASDAQ, or the electronic trading system. For whatever reason, last Friday, there was a halt in trading for approximately 2 hours. Made big news. That isn't generally viewed as a good thing. Halts in trading are generally viewed as very bad because it reduces the transparency of the market, and it could cause major disruptions in the market and the positions that people wanted to take. The exchanges themselves, NASDAQ, New York Stock Exchange, and the equivalent bond exchanges, come under a lot of public scrutiny and a lot of regulation as well. The exchanges themselves, NASDAQ and New York Stock Exchange, would fall under the regulations of SECs, the Securities Exchange Commission, amongst others as well. But the public interest in these trading services comes into question, and it's a matter of transparency and fairness. In the past, there has been some interest or concern that some of these exchanges were not fair to the small trader, for example, or gave a lot of advantages to large traders. So all of those issues come into scrutiny, if you will, when these exchanges occasionally have hiccups. Again, this class is going to primarily deal with not initial public offerings. And again, most of the time when you're buying a stock or a bond or a treasury, you will not have the initial public offering, but will be trading in the already existing share on exchange. Occasionally, IPOs, or often actually when IPOs become public, they make the news. One example of this that you probably may have heard of was Facebook, and Facebook had an IPO a little over a year ago now, May 2012, and that IPO came under a lot of scrutiny as well because of the dramatic fall in the stock price that happened immediately after the initial public offering. The way initial public offerings work is that investment bankers come up and make sales of the stock originally to other institutions that then will try and market those securities to other individuals or get it out into the public holdings. Generally, those investment bankers come up with what they believe to be a realistic market price for the IPO. So investment bankers or whomever was underwriting the Facebook initial public offering came up with the price for the share of that IPO stock. After that, on a certain specified day, public offering begins, and the exchange, the stock begins to be traded on the exchanges themselves. In the case of Facebook, the initial price was too high, and the stock fell pretty dramatically, as will be illustrated on the next slide. This slide, or this overhead, or this graph, shows Facebook stock price. Again, we have our first reading on that Facebook stock price on May 18th, 2012. First day it was publicly traded, and we have these stock prices all the way up to August 18, 2013. If you go to May 18th or 2012, or all the way to the left of the graph, you will see there that the Facebook stock began roughly at $40 per share, and that was pretty close to what the suggested price for the Facebook share was, and then just dramatically fell. It continued to fall, reaching roughly a low of $26 a share, then made a slight rebound, but then in August of 2012 it reached its lows of $20 per share. So, in the process here of the initial public offering, if you had bought that share from the investment banker at $40 and ended up with a share that was worth in September of 2012 $20, you've lost roughly half of the value of that stock, and it wouldn't have been a pleasing experience. As you can see, and again, that Facebook stock hopefully what happens on a initial public offering is that there's not too much variance between what the investment bankers say that the initial price should be and what it actually turns out to be. If there are divergences, something went wrong, and something did go wrong in the Facebook case. As you can see there, then Facebook languished around roughly at the $25 level, but here recently it finally got back to $40. So last August 18th, 2013, Facebook price was over $40. That made the news as well that Facebook's stock price finally was above the IPO price. So we have financial assets, and they're traded on financial markets. In the above cases, we had NASDAQ, which is a financial market, and that NASDAQ market sets prices or aids in setting the prices for the assets, or it's where it's traded. And we had an example there of Facebook when it hit the financial market or the secondary markets. Its price differed from that which was originally offered. There are three roles for financial markets. First, it's aid in setting the price of the assets, and that occurs by the market itself. Buyers and sellers of those assets determine the price. The second is to provide a mechanism to sell and buy an asset. A little earlier in this module, I said that you most of the time would be buying and selling financial assets, or most individuals do, on a trade or in a stock market, and they don't even know who they have bought it from or sold it from. Every time an individual buys a financial asset or a stock, somebody else had held it up to that point if it's traded on a secondary market. But the secondary market makes it such that you don't even have to know who that individual was. Because you don't have to know that individual and you trust the market to provide a efficient and low-cost method of making those exchanges, it does provide a efficient way of trading that asset. The final thing that the markets do is reduces searches and information cost, and a good example of that is go now. Find stock. If it's publicly traded, you can find what it last traded at up to the minute, and so there's very little doubt about what a stock or a bond is currently worth, because all of that information is available publicly. The assets themselves also have important functions, and you see those listed here in 1 and 2. It allows parties to transfer funds from one to another. One individual that has surplus funds can use the financial asset to hold those funds in an asset that generates itself a return. The other role that a financial asset does is it redistributes the risk, and stocks have a particular risk profile, bonds have another risk profile, and there's other ways and means that those assets and the risk thereof can be traded. Derivative markets, for example, futures and options markets, transfers, ways or the risks that are being held in those financial markets. Again, one of the guy gave here a rather simple example. Firm A needs $1 million of funds. They could either obtain that as stock or an equity or as debt. Stock is a residual claim, higher risk, but a claim on earnings. Debt is a specific claim. It has a specific set of payments associated with it, lower risk, and no claim on the value of the firm. As we move forward through time here, stocks and debt, we will look at valuation methods of those two, and they do differ. Stocks, we're always looking at what is the discounted cash flows of that firm or that stock, and that requires looking at the future and making some guesstimate estimate, if you will, guesstimate, of what the earnings will be from that stock. On the other hand, debt, we're simply evaluating default risks. We have a schedule of payments, and we're trying to determine what are the chances of meeting those payments. If the firm meets those payments, they are not in default. If they don't meet them, they're in default. So we're looking at the chances of default. Financial assets are divided into two broad categories, or there are two broad categories of financial assets: equity, i.e. stocks, and debt. Equity, it obliges the issuer to pay based on earnings. We're going to make dividend payments on stocks based on future earnings. There is no commitment to make those dividend payments. The stock or equity represents a residual claim. There is more risk with equity than there is with debt. But with that risk comes a chance of higher rates of return if the company that the equity is held in does well. That equity will increase in value. Debt gives a holder a schedule of fixed payments generally, and we'll talk about that a bit more when we get to that standpoint. It's generally a fixed payments, and then there's no upside there. There's only downside. There are also derivatives, which are based on underlying financial assets. Futures and options contracts are one of those examples. There also is, in some cases, not a clear distinction between equity and debt. Preferred stock would be an example. Preferred stock has some characteristics of equity and some characteristics of debt. This graph comes from the reading that I assigned for this week, the McKinsey Global Institute. Again, this is available on our Compass website. Title of this article is Financial Globalization, Retreat or Reset, and it pretty much gives a nice feel for what's happened to financial assets holdings around the world in the various categories that you see listed on this graph. This graph shows those assets from 1995 through 2007, 8, 9, 10, 11, and the last reading we have is in 2012. You'll notice a pretty major inflection point. Assets were growing from 1990 through 2007. 2008, there was a contraction. 2008, the Great Recession, the financial meltdown, which was a worldwide phenomena. Saw some meltdown there, and financial assets have grown from that point forward, but at a slower rate than in previous times, which probably you can take as an indication of any one of a number of things, but just slowness in growth over the economy compared to the pre-2008 period. Let's really focus on that 2012 bar, $225 trillion. So that's the amount of assets that McKinsey measured at that 2012 date. You can see there that they're divided up into equity, government bonds, financial bonds, corporate bonds, securitized loans, and non-securitized loans. Equity, $50 trillion. These would be the stocks of companies that are traded on those exchanges, so this would be stocks. And this may come as a surprise, but the equity portion of the total market, if you will, total financial asset market, financial assets that exist out there, is much lower than the debt side of things. You can see there government bonds. This would be U.S. Treasuries, French Treasuries, Euro Treasuries. Those treasuries would be listed there under government bonds. Financial bonds would be bonds of financial institutions. Corporate bonds would be corporate bonds of Microsoft, etc. Securitized loans would be items like home mortgages, anything backed by the security of the underlying asset, then non-securitized loans. Now, as we go through this course, we'll be talking about each one of these categories. Equities will be Module 1, our focus on Module 1. Then government bonds, financial bonds, corporate bonds, and those loans will be in Module 2. Again, it may come as a bit of a surprise, but the debt side of things is much larger than the equity side. I'll also point out there that those securitized loans, those would include home mortgages. You'll note that, relatively speaking, it's a small piece, but that small piece is what caused a lot of the 2008 meltdown, the underestimating of risk associated with home mortgages in a securitized loan setting. That came to pass to cause large issues and precipitated some of the financial problems. Might be surprising to note that it's a relatively small piece of this total bar here. Again, though, just gives you a feel for the size of loans that exist out there. And again, read this that article. It will give you a pretty good feel for what has happened in financial assets over the last several years. Putting some more meat to those divisions, or more finer lines to those divisions. We had equities and debt or bonds before. Now we've divided those up into more detail. Equities would still include common stock, and then we will further divide those into growth values, small cap and large cap. Bonds, and now we've mentioned debt before. We've divided those out into bonds and commercial paper. Bonds are generally longer length, although not necessarily so, but have scheduled interest payments, and those would include treasuries. U.S. treasuries will be the one what we're looking at. Corporate bond, which would include financial and other corporate bonds from the other slide, and municipal paper. When we'll talk about all three of those, we'll talk a little bit about Chicago municipal bonds and Detroit municipal bonds, which have made the news here of late. And the final one is commercial paper, and this is short-term unsecured debt. If you held a money market, which many of you may have held, is actually backed by commercial paper. And again, we'll talk about all of these as we're moving through this course. The previous slide talked about equities and bonds. Often those are bundled together and then sold to investors, and those often happen through mutual funds and exchange traded funds. A mutual fund, for example a stock mutual or fund, would hold stocks of individual companies, and then investors would purchase and sell shares of that mutual fund. So, and there's all different types of mutual funds and exchange traded funds. Many of them make it more easy for an investor to hold specific desired or diversify their asset holdings, but it's a way of holding assets in a bundle, and the holding firm, or the person that the firm that originates those mutual funds and exchange traded funds, is offering the bundle to investors, obviously in exchange for money. Their hope is to make that money on those funds through the fees and other items that are associated with those mutual funds. Again, we will be talking about mutual funds and exchange traded funds as we move through this semester. Throughout this semester, what we're going to be doing is looking at financial assets, stocks, bonds, derivative markets, commercial paper, bonds, equities, often held in mutual funds or ETFs, and looking at ways of building portfolios using those items. Just as a note here, again, we're talking about portfolio. An often made suggestion is that an individual start as the basic point of holding a portfolio that consists of 60% of its funds in stocks.
Okay, that was the introduction actually. So I just want to play the video presentation of the presenter for today. So we started from Ms. Bersola discussions.
Good evening, Sir Abante, and good evening, classmates. So tonight, I will be discussing measuring and testing co-movements in return. Just to give an overview, this chapter will talk about how correlation and regression relate to the return of a particular investment concerning its dependent variables. For example, the relationship between the returns of investment about inflation. We will tackle different techniques as we proceed with our discussion. Correlation and regression. The most commonly used techniques for investigating the relationship between two quantitative variables are correlation and linear regression. Correlation quantifies the strength of the linear relationship between a pair of variables, whereas regression expresses the relationship in the form of a equation. For example, in patients attending an accident and emergency unit, we could use correlation and regression to determine whether there is a relationship between age and urea level and whether the level of urea can be predicted for a given age. Measuring linear association. The first stage in detecting whether a linear relationship exists between two variables is to plot a scatter diagram. When all the points on the scatter diagram lie on a straight line with large values of one variable is associated with large values of the other variable, there is a perfect positive correlation. If the line is such that large values of one variable are associated with small values of the other variable, there is a perfect negative correlation. How steeply the line slopes simply indicates how large a change would be produced in one variable by a fixed change in the other variable. We will consider two Pearson's product moment correlation coefficient R for when the data have numerical values and Spearman's rank correlation coefficient RS for when the data are defined by their position. In each case, the value of the correlation, the coefficient will always lie in the range -1 to +1. +1 signifying perfect positive correlation, -1 signifying perfect negative correlation, and 0 indicating no correlation. Pearson's product moment correlation coefficient detects the extent to which the data points lie on a straight line and may be defined as the formula in this presentation. But before we understand it, we must know how to read a summation notation. Spearman's rank correlation coefficient. When the data can be placed in order but not given an absolute size, Spearman's rank correlation coefficient (RS) is used, where D is the paired difference in ranks and N is the number of pairs of observations. As you can see in this table presented, the calculated figure is shown. Least square regression. The least squares regression line y on x is placed on the scatter diagram so that the sum of the squared vertical distances from the point to the line is minimized. The line is positioned so that the smallest value possible for this particular point. We sum squared distances because some points lie above the line and some below. Those above have positive deviations from the line and those below have negative deviations. If the deviations were simply added together, they would tend to cancel each other out. There would be more than one position of the line for which the total was zero, and some of these would not look like a good fit for the data at all. Summing squared deviations remove this difficulty. The regression line has equation y hat is equal to a plus bx and enables predicted values of y to be obtained from known values of x. The, con- the constants a and b have to be calculated in reverse order using. An important property of the least squares regression line is that it always passes through the point xy. This fact provides a quick check for the accuracy of calculations carried out to find the position of the line. Let us now find the least square regression line y on x for the data in figure or in this diagram. The formula for a and b require us to know the values of most of which are already known from the calculation of r in this section, the rest being easy to calculate from the diagram. If we wish to plot the regression line, we must calculate the position of 2 points and join them using a straight edge. The calculations should be checked by finding the position of a third point and ensuring that it does lie on the line which has been drawn. For the first 2 points, it is usual to choose values of x that are towards the extremes of the x and range and which keep the calculations as simple as possible. The coefficient of determination is a statistical measurement that examines how differences in one variable can be explained by the difference in a second variable when predicting the outcome of a given event. In other words, this coefficient, which is more commonly known as r squared or um, it assesses how strong the linear relationship is between two variables and heavily relied on by researchers when conducting trend analysis. To cite an example of its application, the coefficient may contemplate the following question. If a woman becomes pregnant on a certain day, what is the likelihood that she would deliver it normal? So this is the end of my report. Thank you and God
Okay, so this will be a video presentation about measuring, of course, a return. No, is it important? No, before we play the video presentation of Miss Vidanyo, I just want to share this one first as a measuring returns, discussions, of course, and
module, we're going to discuss how we calculate returns, or how we measure those returns and how we calculate those returns. In finance, that's a bit different than maybe we would look at from an accounting standpoint, but essentially what we're doing when we're measuring returns for financial measures or financial use is to look at cash flows and discounted cash flows. As I stated on the previous slide, finance is concerned about cash flows and the discounted cash value of cash flows. So everything in finance revolves around those cash flows, when they got them, and again, the present value. Second point here on this slide is that we in finance, or when we're looking and doing financial analysis, we do not explicitly use accounting returns. We don't use net income measures that are calculated for corporations. We don't use the return on assets, return on investments that are calculated by the accounting profession, because those aren't explicitly related to cash flows. Those accounting reports, while we don't use them, are useful, as they may provide a signal for future returns. One of the things that you'll notice if we have an announcement of earnings announcement of a corporation, that may change its stock value. Sometimes it will, sometimes it won't, but most of the time those stock value changes are because the accounting earnings are different than what was expected, and that may signal something, either better returns in the future or lower returns in the future. So while those accounting reports aren't specifically used in calculating and looking at financial returns, they are useful as a signal for future returns. Another point, and this is a big one, is that we are concerned about future cash flows, those cash flows that are going to occur in the future and the attendant risks around those cash flows. We really do not care what previous returns were. We don't care what the cash flows were in previous periods from a stock, but what we do care about is future returns. And while we're going to spend a lot of time in this module talking about and calculating historical returns, it's very important to remember that the historical returns really are only serving as a guide for estimating the future returns. Again, what we're concerned about the future returns, the companies, if we're looking at a corporation, previous history may provide a very good indication of what they will do in the future. Therefore, we look at the past returns only to get a gauge of what future returns will look like. I'm going to introduce this notation now as we calculate returns from the period, for a period. And you have this notation here listed on this slide as well as on the notes. T was a time period. For our case, we're going to say it's a year, but it could be a day, month, or week. And in fact, in the next module, we'll be calculating daily returns for Microsoft. So that time period could be a year, or a day, or a month, or a week, for that matter. It's important that it's consistent or the same throughout the analysis. V sub t, second line there, big V sub t is the value at the firm at the end of period t. This for a stock is given by its stock price. So a stock price, Microsoft, the value of that firm is given by the value of its stock. We have one value measure, V sub O, which has a special meaning. It's the value of the stock price right now. So V sub O, if you're looking at this right now, would be the returns that are being quoted on the stock market as of this point in time. D sub T here is the dividend of the stock, and small d is the discount rate. And we're going to use this notation throughout. I describe this notation in terms of a stock, but you could do just as well as with a bond. For example, bond, V sub T would be the value of the bond. D sub T wouldn't be the dividend, but would be the cash flow or the interest or the payments from that bond. Again, this slide deals specifically with V sub O, or the stock price. And it's important to realize what a stock price, at least from a financial perspective, really is. It's the value of the discounted future cash flows from that firm. So here you see it listed. V sub O, or the value of the stock, is the sum of the future cash flows discounted to the current time period. The market is always changing in its assessment of the value of discounted cash flows, or the market price. So and we're making the assumption here that the market price represents the value of the discounted cash flows. So as you're looking at the stock price, and it changes from minute, day, and it goes up, for example. Let's say the stock price was $100, now it's $110. What that signals is that the stock price went from 100 to 110, $10 increase. The value of the discounted cash flows went up $10. Conversely, if it goes from 100 to 90, that means is that for whatever reason, the value of future cash flows have gone down by $10. So what we're going to do is see V sub O change day to day, and it will go up or down. But in this class, we're asking what the current stock price, what will cause it to go up. And again, here you can get some intuition behind that by looking at the equation on the previous slide. And two things will cause the price to go up. First, returns expectations go up. We expect higher returns from the stock. So we have a better income outlook. That will cause the stock price to go up. The other alternative is number 2 there, and that is risk goes down. So for whatever reason, the stock becomes less risky. Something in the environment causes returns expectations to not change, but the value of the risk, or the risk that's out there, to go down. Both of those things would cause the value of V sub O to go up, or the stock price to go up. Here's a graph of the Facebook stock price, and again we're beginning at 518 going to 818. You saw this graph in the previous module, or module 1, and what we're showing here again is the stock price, and as you can see, it's varied over time. It was started out roughly at $40 and then got close to $20. And at the point, and that's where this that circle is, we reached that $20 price. And at that point in time, what individuals were saying is now the discounted value of the future cash flows from Facebook were much lower than initially estimated. A lot of that revolved around being able to develop revenue from the Facebook company itself, and whether or not advertising was the discussion point of whether that would allow Facebook earnings to grow in the future. So that uncertainty, or the belief that it didn't happen, was what caused Facebook stock price to go down. As you can see then, it bobbed around there, but in recent months it has increased, and a lot of the reason why it has increased is because of less concern about advertising revenue, or there's much more assurance of the revenue stream in the future. I want to give another example of a stock price change, and here is a more specific case. Last week on August 24th, 2013, Steve Ballmer, the CEO of Microsoft, announced that he was going to step down and they were going to begin searching for his replacement. Steve Ballmer has been the CEO, Chief Executive Officer of Microsoft for a long time and has been with Microsoft from the beginning. So this is one of the key people that has been involved in Microsoft. When he announced his stepping down, and you can see the sub-headline there showing, indicated by the hand that showed up, that Steve Ballmer to leave within a year, stock price jumps 7%. What that stock price jump meant is that the market, or collectively the people within the market, thought that Steve Ballmer leaving was good for future cash flows, and stock price jumped 7%, which is a pretty significant jump for a one-day change in the stock. That, if you're Steve Ballmer, isn't a vote of confidence. In fact, it's a good kick in the teeth here. Thanks for leading this company. But just some of the market indications of Steve Ballmer's worth, or the change in the worth to the company. In fairness, I'm not sure that was warranted. Microsoft has been a very profitable company. It generates obscene, in fact, profit margins from its business, or not obscene, but very large profit margins from its business. What everybody gets concerned about is that its two major products, Microsoft Office, which most of you are going to be using Excel as part of that Office, and Microsoft Windows has a limited life to its technology, that someday Office and Windows won't be as dominant and will be eaten into by other modes of computing. So there is that concern that those two main products that generate a lot of the revenue won't exist forever, and that Microsoft is slow to innovate. An interesting fact is that Microsoft did in fact invent a tablet similar to the iPad, but chose not to market that iPad. And again, some people would look at that and say, hey, they had the technology, they were developing it, and chose not to go forward. It's a sign of their risk averseness, and that is one reason why we don't expect the cash flows to remain as good for this company into the future. Whether or not that is the case will remain to be seen. Microsoft has had a good run, and people are making their judgments, and some people think those judgments are optimistic. Some people think those projections are pessimistic, and the market comes together on that market price. Now to the nitty-gritty of calculating returns here. And this equation gives the returns v sub 1 minus v sub o plus d sub o divided by v sub o. Let's go through some of the intuitions of that. And that's a rate of return. This will be a percentage. R sub o will be a percent. Let's go through some of the intuitions. V sub 1 minus v sub o is price at the end of the period minus the price at the beginning of the period. This is the capital gain. This is the change in the market value of the stock. So this is the market's estimate of the change in all the discounted cash flows in the future. Capital gain. Second term up there is D sub O, and that's the dividend payment or the current return or the cash return. Those two are added together and divided by V sub O, or the stock price. That stock price represents what it would have taken to make an investment. Sometimes in these calculations you see that V sub O replaced it by stock price at the beginning of the period plus the one at the beginning and ending stock prices and dividing by 2 or calculating the average. I personally prefer to do the stock price at the beginning of the period, and because that's sort of the rate of return that you would get given that you've made an investment in that asset. But here's the equation for calculating the return or the total return from an asset. Here's another way of looking at that, and this takes that equation and puts it into words. There's 2 types of returns from an asset: the current return or the cash return. That would be interest, dividends, rent. The second type of return is the capital gain, and that's the change in the market value from one period to the next. The total return equals the current return plus the capital gain, and this is applicable to all assets. It's real estate, stocks, and bonds. Final point here is remember that V sub O equals the present value of future returns, and that does make an important assumption here, and that is that price equals value, that the market results in price equaling the value or the discounted value from that asset. We're going to nail this capital gains through all here. We're going to talk it about again, and I'm very big on the interpretation of capital gains and what it means, and so don't be surprised on the test if we have a question about capital gains and what it means, and you better get it right. All right, here in equilibrium, remember that if we have an equilibrium, our market equilibrium, price will equal value. So the value of the stock is its discounted cash flows. And we have good reason to believe that most of these financial assets are in equilibrium. You can argue that, but in general you'd find that they are in equilibrium. V sub 1 is the price at the end of the period, and it's a discounted present value at that time. V sub O is the beginning of the period, so the capital gain is the change in present value of expectations of future returns during that period. Now we're going to go through some of the mechanics of calculating capital and current returns using historical data. Here we give an example from land, and here land has its current return as cash rent. Here you see 2 years, 100 and 105, and the price, $3,000 and $3,200. Perhaps when you see a outline of returns and prices, the most confusing, and people will do this differently, is where the rent and the price falls. In my example here, I am saying the price is as of the beginning of the year. So the $3,000 price refers to the beginning of 2006. The price $3,200, final price in that series there, refers to the price at the beginning of 2007. So the $3,200 and $3,000 bracket the year 2000, and the $100 return occurs in 2006. So this example, we're calculating the returns for 2006. Current return is $100. Capital gain is $200. And total return is $300. You can see the calculations there and where they come from. We can state those in percents. 100 divided by 3,000, or the price at the beginning of the period, capital gain, and then total return. Here we have a 10% total return. Often financial assets, the major portion of the return is capital gain. Many companies, in fact, don't pay dividends. They believe that they can make a better investment, if you will, or return on their investment than the individual stockholders, so they keep those returns. So often, the majority of the returns is capital gains. Here's another example from our XYS stock example, and you can see the dividend and the prices. And one of the hallmarks is to calculate the current capital gain and total return for this example stock. Here is another example bond return. Here, the current return is the interest repayment or the current cash flow, and you see the prices there. Calculate the total return, current return, and capital gain for 2012. Note in this case that the capital gain may be negative, so total return may in fact be negative as well. Capital gains can be negative, obviously, because during periods of price declines, we'll have negative capital gains. This concludes
Okay, so this time I just want to play a video presentation of the other presenter.
Everyone, my name is Mary Grace Vidaño, and my topic for today is all about measuring and testing co-movements in return. First, let us define what is co-movement. Co-movement refers to the correlated or similar movement of two or more entities. In finance, the co-movement of asset returns is crucial to the cross-sectional diversification and management of systematic risk. Covariance and correlation. Covariance is a statistical measure that shows whether two variables are related by measuring how the variables change in relation to each other. The covariance between two random variables can be positive, negative, or zero. A positive number indicates co-movement that the variable tend to move in the same direction. A value of 0 indicates no relationships, and the negative value shows that the variables move in opposite directions. Correlation is a measure of how two variables change in relation to each other, but it goes one step further than covariance in that correlation tells how strong the relationship is. To determine the strength of a relationship, you must use the formula of correlation coefficient. This formula will result in a number between -1 and +1, with -1 being a perfect inverse correlation and +1 being a perfect positive correlation and 0 indicating no relationship between two variables. The correlation between two variables is particularly helpful when investing in the financial markets. For example, a correlation can be helpful in determining how well the mutual fund performs relative to its benchmark index or another fund or asset class. Correlation coefficient. The correlation coefficient is a statistical measure of the strength of the relationship between the relative movements of two variables. The degree of association is measured by a correlation coefficient denoted by R. It is sometimes called Pearson's correlation coefficient after its originator and is a measure of linear association. There are two types of correlation coefficient. Pearson correlation is the one most commonly used in statistics. These measure the strength and direction of a linear relationship between two variables. Spearman rank correlation. A plot of the data may reveal outlying point well away from the main body of the data, which could influence the calculation of the correlation coefficient. Alternatively, the variables may be quantitative discrete, such as a mole count, or ordered categorical, such as a Payne score. A non-parametric procedure due to Spearman is to replace the observations by their ranks in the calculation of the correlation coefficient. The equation of correlation coefficient, where Pearson product moment correlation is equal to covariance of variables x and y over standard deviation of x times standard deviation of y. Regression. Regression is a statistical technique that relates a dependent variable to one or more independent variables. Regression helps economists and financial analysts in things ranging from asset valuation to making predictions. Regression can also help predict sales for a company based on whether previous sales, GDP growth, or other types of conditions. Linear correlation coefficient. Positive correlation indicates a perfect linear relationship. For example, the two variables move in the same direction with equal unit changes. For negative correlation, indicates a perfect inverse relationship. For example, a unit changes in one means that the other will have a unit change in the opposite direction. And if there is no linear relationship at all, then the correlation will be zero or no correlation. Coefficient of determination. The coefficient of determination is a statistical measurement that examines how differences in one variable can be explained by the difference in a second variable when predicting the outcomes of a given event. This measures the percent variation in the response variable that is explained by the formula. The coefficient of determination and the linear relationship coefficient are related mathematically. That would be all. Thank you.
Okay, so this will be an example of a co-movement returns.
Present a couple of examples of measuring returns. Both of these examples are going to use Microsoft Excel and the spreadsheet that you could have downloaded or can download from the Compass website. So we're going to divide this module up into 4 steps. First is calculate total returns from farmland. This again will come from that Excel spreadsheet. Then we're going to use the Microsoft data and we're going to do 3 things. First, we're going to download it from the Yahoo Finance website. We're going to define adjusted closing price, something that we're going to use with the Microsoft data. And 4, we're going to calculate returns using the adjusted closing price, which is something relatively simple and straightforward. Here is the screenshot of Week 1 measuring returns. Again, this is the spreadsheet that is available for download from our website. And we are on the farmland sheet or tab here. So we want to be on farmland. And here is the data that we have here. Right here. We have yearly data on farmland returns. This happens to be USDA data and it's for Illinois. So we're looking at Illinois farmland returns. We have here a cash rent. So this cash rent is an estimate of the amount paid for farmland, or for renting the farmland. So if an owner had the land, and often owners don't farm the land while still owning it, they will receive cash rent from their farmer tenants. So this is that cash rent payment. This would be our current return. We also have land prices here, and those land prices are estimated at the beginning of the year. So this $490 land price is estimated as of the beginning of 1970. This land price, $491, is estimated as the beginning of 1971 or the end of 1970, whichever you prefer. And this cash rent, or the current return, is $36. Over here, we're going to calculate, or have calculated, the current return, capital gain, and total return. We also then calculate the percent total return. And if you need those definitions, go back to our previous module and you can see the definitions of cash return, capital gain, and total return. I'm going to erase these columns now and just do those calculations. Hopefully that'll help you cement in your mind what we're doing here. And I'm going to put a screen in here so that we can see to the bottom. Okay, we're continuing this example on the next slide, but what I've just excuse me, just done is split the screen. We now have this data from 1970 to 2013. This, by the way, I do quite a bit of work in farmland prices, and this is a usual data set that often is used for the state as a whole. There's a lot of variability, obviously, within the state. Or maybe not so obviously, but there is a lot of variability in returns and farmland prices across the state, with more productive land having higher cash rent and higher land prices. For each year, we want to calculate a capital return, capital gain, and total return. Here, our cash return is our cash rent. Our capital gain is the change in prices. And here, perhaps, the only thing that you have to really consider is the definition of when these cash flows occur. The land price is giving it at the beginning of the year. The cash rent occurs during the year. So this is correct. Sometimes you'll see some people do it where this would be the current return for 1971, and it all depends on the definitions. But we have cash return, capital gain, and our total return here is the sum of those two. So in this year we had cash return of $36, capital gain of $1, total return of $37. Take the $37 return and divide it by the price during the period, and we have an 8% return during that period. Alright, we did those for one year. I'm going to highlight this, then I'm going to copy, and paste, and now we've created it. One thing I'm going to do here is 2013. We're going to just delete that row, and we're done. So we've calculated the capital gains, cash returns, and total returns for farmland. You could save this now, and we would have completed our task. I want to give you a little intuition of returns here, which will come back later. But I'm going to graph the land price series. Here's what's happened to farmland prices in Illinois, as well as most of the other places around the world as well, or around the nation, actually around the world. Put some dates on here. As you can see here, farmland prices have really increased quite a lot. 2012, they were close to $8,000 an acre for a statewide average. We sort of had a big increase here in the late 70s, early 80s, then a decline. That is some concern today, and since that point in time, we've had a sharp increase in farmland prices, particularly in the late 2000s. Roughly beginning at 2006, we've had $3,000–4,000 added to farmland price. So we've seen some pretty good capital gains and land price increases over this time period. Let me also put in here a graph of percent total return. And here's percent total return, and you can see here again we've had pretty positive returns here, close to negative return here. One of the items to note about this return series is that it's going to be time dependent. There is a period when we had falling returns and falling total returns, and a period that didn't occur. That is going to become important later, and we'll discuss that in next week's chapters. Now I want to switch to the Microsoft example here. Here is the completed Microsoft Excel spreadsheet. And what we have here, and I've split the screen again, we have data in here from March 13th, 1986 up to the present, August 26, 2013. Every trading day, we have the open for that day, high for that day, low for that day, close for the day, volume, and the adjusted close. From this adjusted close, we're going to calculate this return here, and this is the total return. And I'll explain how we calculate the total return. But first, I want to describe the process for getting the data. We are going to get this data from Yahoo Finance, and I am going to start here. I'm just going to Google Yahoo Finance. And here is the Yahoo Finance data page. And the web address is finance.yahoo.com. So here's our web page, and it's loading right now. And it's going to take a little bit because I have a slow modem today. But what we're going to do here is we're getting closer and closer to this thing being loaded. The reason why we're loading, here we have the Microsoft Corporation quote, and I guess I keep track of that, minus 2.6%. We're going to search finance. I want to get Microsoft data. As part of the homework, you'll get Exxon data. You can either type in the corporation name, or if you know its ticker symbol, we could go MSFT here as well. Well, let's just do that. You could put the name here or the ticker symbol. Search finance. There it is. We have Microsoft Corporation 33.26. It's down 8.89. Here's the trading for the day. Well, I want to demonstrate to you how to get the historical prices for this. Come over here just to hit historical prices. And you will see a list here of the historical prices. Here, this data range starts March 13, 1986, the first day of trading. It ends now, August 28th. I'm recording this, I'm recording it on August 27th, so I don't know why they're saying August 28th. Last date here is August 27th. We want to get daily data, but you could get weekly data, monthly data, and dividends as well. Daily data, and you type get prices. We've already got the prices. Here's the adjusted close. They had a dividend on August 13th, 2013. Come down to the bottom and click Download to Spreadsheet. My browser puts the Download to Spreadsheet here, and now you have the data in a spreadsheet. Here is that data. So we have the date, the open, high, low, close, volume, adjusted close. It's been downloaded into spreadsheet. The one last thing that I want to do is sort this data. It begins on August 27th. I want to just put it in reverse order, earliest at top. Just do a data sort. I want to sort by the date column, oldest to newest. You're done. And I just, for good measure, inserted a couple columns here. And you have the data that is on that sheet. We are going to calculate the returns using the adjusted closing price. And the adjusted closing price is a standard way of restating the return series, or excuse me, the price series, the closing price series, so that you can easily calculate the returns from the from that series. We can also use it in the calculation of geometric means. Here we have the adjusted closing price. You can see the formula here. Adjusted closing price, AV, ending closing price minus beginning closing price divided by AV. That will give us our total return. This will include both capital gains. You can restate that as ending divided by beginning return divided minus 1. The adjusted close is there's standards for calculating the adjusted close. I included here on this slide a brief description from the Yahoo Finance website. If you want to see the whole thing, just type in adjusted close, Yahoo Finance, and the screen will come up. Here's a definition of the adjusted close, but basically it adjusts for stock splits and several other things. Here you see the explanation. There's also a dividends multiplier, so it accounts for dividends and stock prices as well as other corporate activities. We're back here to our website. Here again we're back here to our Microsoft Excel sheet. We have the adjusted close here, and I am going to calculate total return here. I've done it in this column. Let me erase this and just do it again. I'm going to use the formula on the previous slide. Adjusted close from end of period minus the adjusted close at the beginning of period minus 1. Let me give some decimal places here. And then copy that down. Oops. We've just calculated the return series using the adjusted close. Let me just graph this to show you what that looks like. Here's what that looks like. You can see it looks pretty, well, we got a lot of data there. Alright, we've shown here two examples of calculating returns, one for farmland, one for Microsoft stock using the adjusted close. You'll use these exact same methods here for the adjusted close in Microsoft. Download the data for the Exxon Corporation as part of question 3 on the practice homework. This now concludes this module on calculating returns.
Okay, so this will be the last video presentations, no, on how we could able to understand the investment returns and the risk. Okay, this will be also covered with the full movements and returns, no. So
Final module of the week, 1.4, 1-4, investment returns and risk. This is going to be like rolling off a log. We're going to discuss in this module average returns, which we're going to measure with either the arithmetic average or the geometric mean. We're also going to talk about the variation, which we'll measure with the standard deviation or the variation. And the other measure we're going to talk about is the correlation coefficient, and that is a measure of how two series move in relationship to one another. So we're going to discuss all of those three things, first focusing on the arithmetic average and geometric mean. Here is the definition of the arithmetic average. R sub A is the arithmetic average or arithmetic mean. It's the sum of all the periodic returns divided by n. So it's the arithmetic average. It's the one when you've calculated in statistics, and it is the most common mean that you will see reported. Straightforward calculation. Here is the definition of the geometric mean. R sub G. What you do is take the product of 1 plus the periodic returns, take raise that to 1 over n minus 1, and it's the geometric mean. It has a very nice interpretation. If you take $1 invested at the beginning of the period and hold it to the end, reinvesting any dividends that you have invested, R sub 1, remember, includes both dividends and capital gains, so we're explicitly making the assumption here that dividends are reinvested. It shows how much will be available at the end of the period. I'm hopefully going to give a little bit of intuition mathematically to that in the next slide. I'm going to give some intuition behind this. Equation 1 here gives the definition of the geometric mean, so that comes from the previous slide. Equation 2 shows the same thing as equation 1. We're just taking the 1 over to the other side, so just rearrange the formula a little bit. And then equation 3 multiplies through or takes the n over to the other side. So here is the expression in equation 3, same as equation 1. Now look at that equation. This is the definition of the future value, or if you will, or the value of money currently invested now, 1, with each period, 1 plus R1, or 1 plus R2, with that return each period. The geometric mean on the left-hand side of the equation just finds the factor that equates all of that. So that is the intuition behind the geometric mean. Alright, let's give an example of the mean and geometric mean in this sheet. Go to the mean geometric sheet in the Excel worksheet that I handed out. I'm going to show returns for 3 years for 4 assets. Asset A, Asset B, Asset C, Asset D. Asset A has a 5% return in year 1, year 2, and year 3. So its mean, or its average, would be 5%. Asset B has a little bit of difference, 0.03%, 3% in year 1, 7% in year 2, 5% in year 3, still 5% return. 5% return on asset C and 5% return on asset D. So all of these have the same arithmetic average. Minus 1 is the first year return, so we had a negative return. 2 and 5. Minus 4, or minus 40%. Big downturn. Still a 5%. Had a big upturn in the next year. In calculating the geometric mean in Excel, it's done over here, and here you got a trick. There is a function to calculate geomean in Excel, but you have to trick it a bit. I'm just giving you an example here. What I do is take the return, add 1 to it. Reason why I do that is the function Excel will not work if there's a negative return in it, or negative number. So if you tried to calculate the geomeans just here directly, let me just show you. Negative numbers don't work. Gives you the number. Alright, so we have these. Come over here, calculate the geomean, and subtract 1. Let me put these geomeans here, over here, so we can do a comparison. Asset A has the same arithmetic and geomean. Asset B about the same, or it's the same. Asset D, or C, arithmetic average, but lower geomean. Asset D actually has a negative geomean. What we know about geometric means is that when there are negative returns, they will differ from the arithmetic average. Geomeans will always be below the arithmetic average, and the more pronounced the spikes below 1 are, the more the geomean will be below the arithmetic mean. So this had a bigger spike, so our arithmetic average was below that, or more further below it. Here's the intuition. Remember what the geomean does. It calculates, if you invest $1 at the beginning of the period, how much you will have at the end of the period, given that you reinvest the returns in the asset. Let's show that. And here we've done this. This is 1 plus the asset. So we can do those calculations if we invest $1 in year 0 right over here really easily. If I invest $1 in year 0, I will have $1.05 at the end of year 1. If I invest in asset A, if I invest in asset A, I'll start at 1.05 at the beginning of year 1. I have a 5% return, get 1.10, and at the end of the year I'll have 1.15. Let's come over here and look at asset D. If I invest $1 and have a minus 40% return, I will have $0.6 at the end of year 1. I have a 45% return in year 2, but I started out with 60 cents, and 45% return on 60 cents only gets me to $0.87. Another 10 cents, 10% return, I get to $0.957. So my $1 is $0.957. That follows it through. I could do the same thing. Remember my reworking of the equation here? I can take 1 plus my geometric mean, raise it to the 3 power in this case because we have 3 periods. Oops. Gotta put a parenthesis around that. 1.15. Exactly the same. So this is my yearly average return, given that I invest $1 at the beginning of the period. In a lot of respects, the geometric mean is preferred over the arithmetic mean. It sometimes is difficult to calculate. Here's the definition of the standard deviation. Same standard deviation definition you've seen, mathematical formula. Higher standard deviations mean more variability, more risk, and that's generally not preferred by an investor. More risk, less preference, so we would like more stable returns. Investors prefer higher returns, higher arithmetic averages, higher geometric means are preferred, and lower risk, so lower standard deviations. Here is the definition of the correlation coefficient, the correlation between x and y, our two series, x and y. Again, we use this, and this is going to be a very important variable when we talk about diversification. In the red there, you see the interpretations. 1, if we have a correlation coefficient, then correlation coefficients range from 1 to -1. 1 would be perfectly correlated, -1 would be perfectly uncorrelated. Here's how this works. If we have a correlation coefficient of 1, the two series move in lockstep with one another up and down. -1, they move with lockstep with one another but in opposite directions. One goes up, the other one goes down, and vice versa. 0 means you cannot discern a pattern by what, if X does something, you don't know what Y does. From a diversification standpoint, you want the lowest correlation coefficient you can get. In fact, if you had a negative correlation, -1, or even a negative correlation, you can make an asset by combining the two assets such that you can have a safe investment. Obviously, negative correlations do not occur very often. Even with high positive correlations, though, you can come to the point where assets, as you increase the diversification or increase the number of assets, even with high correlations, you can lower risk. And that's one of the things that we'll talk about next week. Final example here, correlation coefficient. Here we have asset A, asset B. Here we have the mean calculation. This would be the arithmetic mean. 0.057. It's average and function in Excel. Average function of B. Over here we have the geometric mean calculations, just like we did before. Standard deviation is STDEV. Correlation is correlation, CORREL. Correlate this series with this series. Alright, looking at these assets. Asset B has a higher rate of return, but higher risk. Correlation coefficient is 0.29, so they're less than perfectly correlated. That completes our modules this week. We'll be talking more about mean and standard deviations next week. And as you're doing the homework, you will get to calculate mean, standard deviations, and correlation coefficients.
Everyone.
Okay, so I just want to add additional inputs no, related to the discussion, because based on the given approach no, on how you'll be able to use Microsoft Excel in a computation, there are certain approach based on the estimation of a conditional probability that a random variable no, falls below a given conditional quantile. No? And most commonly, these estimated codependence can easily be visualized in what we call the co-movement. No? And again, there are certain formulas, no, that we will be able to use to get the co-movement returns. Okay, so I think that's it for this topic.